freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Hi, Adam.
Hi, Dustin.
I said your last name really high-pitched there.
That's because you were nervous.
Yes, I'm nervous about after however many episodes we're in on this one. I still get nervous.
We are, digressing on your ability to say wealth independence.
Wealth independence.
No, real wealth. Real wealth follows.
Yeah, that's the one. Real
yeah, in
wealth.
the end, we sometimes have to record the outro like 3 times. It'll turn into like a real wealth.
Yeah, we should start publishing a blooper or
a blooper reel.
Outtake reel, yeah.
Might be the most popular episode.
How many times it takes me to say real wealth. I have a tendency to do that with some words. I noticed when I was doing my flight training, was flying the 172 a lot. I would say
the East Tennessee accent.
Probably. But I also will push words together, like using the call sign of Skyhawk. After, the 10th lap in the pattern, it eventually just becomes Skok. Skok, non-Juliet Echo, and, and eventually I caught myself and I'm like, I'm not even saying a word now. Like, it's just a noise. Anyway.
It's like a hawk.
Yeah. Well, speaking of things that are just noise, that actually might be a pretty decent lead in to our topic for today.
The Wall Street Journal.
Yeah. So 3 articles here, all kind of related. We want to do, we get decent feedback on these article review episodes. So I guess because they're timely, but I also thought not only is this timely, but I feel like there's a narrative that is out there that is being pushed by the mainstream financial media that's true, but overbroad. So, and it directly relates to a fund that we have. And so
I think that goes back a little bit to the macro. I was talking to someone about this the other night. We hosted an investor meetup and Victor Minaj was there and some macro things were coming up. And this guy was newer in real estate. And he was like, what do all these words mean? Well, what are hypothecated bonds and what happens with the 10-year treasury and what do all these things mean? I'm like, he's like, where do you learn that stuff? I'm like, I think it's good to learn.
Yeah.
I don't know that it matters when you're flipping houses or investing in single family homes in rural Northern California.
Yep. Completely agree. And I think that's where this is probably a whole episode in itself, but one of our mentors who talked about getting wiped out in 2008 and then decided he needed to learn macroeconomics to prevent it from happening again. I feel like that's a little misguided, to be honest. Like, there's nothing wrong with it, but we've threatened to record an episode on this where I think that most macro is BS.
I think we want to tie this back to these articles we're going to review, but I think it's good to be in the know, right? You don't want to be caught off guard by a macroeconomic event because, it is funny. When we were in, I don't think it matters that we say this on a recording, but when we were in Napa for our investor meetup, we had a speaker say that, this is how I'm going to do it, I'm not going to say who the speaker was. We had a speaker say that, if Trump wants the midterms to go well, we need to have American flags flying in Iran by the midterms. That meetup was February 24th.
Mm.
So I think he was pretty accurate.
Yeah.
I don't know that it drastically changed the whole U.S. environment when that happened, but if you were buying oil future contracts based off of that and you had 6-month futures because you just thought it had to go before the midterm, that's not something I did, but those are the things where I think it does matter and it does play into a larger trend.
Totally agree. And I think that's kind of the difference of if you are going to place maybe short-term bets based on larger events, that's completely different from we're going to study the deep, dark internal plumbing of the financial system so that we can be prepared when it eventually collapses. Like everyone has been doing for the last, not everyone, but the people that care about this have been saying this for the last 40 years, right? Like it's this perpetual sort of thing. So I agree. It's important to kind of differentiate the stuff that does matter and is actionable and like you can actually do something about right now versus this like mostly intellectual, hypothetical threat that is really taking theories that are not falsifiable. Okay, that's probably enough to say on that for now.
I think we should dive into the articles.
I think we probably should. That was enough of a digression. So, for some background on this, the last month or so, and really kind of leading up, I don't know, even the last 6 months, there was occasional headlines about this, but really in the last month, we're recording this here in early March 2026, the words private credit have kind of cropped up all over the traditional financial media, right? And it's not been in a good context. And kind of the poster child for this is this company called Blue Owl Capital, one of the biggest names in the space, and they're basically in crisis mode right now. Their stock's down something like 30% year to date. They've got several funds. They've halted redemptions in one of them, and then in another fund, they've sort of fire sold, over $1 billion worth of their loans. So there's a lot of scary headlines going on. A lot of them conflating private credit as a whole being in crisis, and I just kind of want to walk through this and talk about why we don't really think that's the case. I hesitate to use the word contained, but it's different from the private credit that we're involved in.
It's funny because this was a conversation in Napa, but part of the conversation was Victor actually said, he brought up the Blue Owl thing. It happened that day.
Mm.
And it was like, hey, there's this private credit blow up. It was a dinner discussion. And one of the people was there was an investor in our private credit fund.
Yeah.
And I really kind of said, our private credit is much more akin to private equity in real estate than it is actually private credit as Wall Street says it.
Yeah. And Adam, I think that's really the big takeaway from all of this is that especially if you're seeing this in the mainstream financial media, you need to read into the details because the details matter here. And they're using a very large label to describe a small part of what's going on here. And so I won't spend a ton of time here on this first article. This was the feature that the Wall Street Journal did, I don't know, a few days ago, actually, March 1st, really on the guys that started Blue Owl and some of the background there. But the biggest thing this is really just more for background. You got these two guys, Ostover and Lipschultz, started this, and they had a lot of backing. I think they had some backing from, where was this? Some of their own assets, because they're both former private equity guys. And they had, I don't know, there was somewhere in here, I'm losing it, but like Mark Zuckerberg's family office invested and a few other fairly prominent people. I think they were like Soros backed as well. So they had a lot of backing. They had a lot of success right off the bat. It talks about, they became instant billionaires. They bought a hockey team. I think it was the Tampa Bay Lightning, piece of the Washington Redskins, and big expensive property in Palm Beach. And so anyway, they grew fast, and their main thing was, I don't know if it's in this article or not, but they were lending against software companies. That was sort of their specialty. And so this is private credit, so it's private loans, right? So I guess to sort of answer the question here of like, what is private credit? It's just non-bank lending. So it's lending outside of the banking system. And, while we do it on real estate, it can be done on anything. If you can make a loan anywhere. Technically, hard money loans are a form of private credit, but they don't typically get this label.
I think something that's interesting to note on that is one of the reasons that it is not just a blanket label, because a lot of it depends on the underlying asset. Loans to a software company have a different private credit risk than loans to a real estate asset. One thing that I thought was interesting was Victor actually gave this as an example, and stop me if I'm too far off track here, but private credit is basically anything that a bank does not want to lend on. And an example is maybe the invoicing on, I think it was Victor that said this, or was this the trade credit that we talked about where the invoicing on the software?
Yeah, we had a guest. Yep.
Yeah, talk about the invoicing on a software that Zurich wouldn't,
yes,
the bank wouldn't loan on, right? Like you're
to
like
the city of Zurich.
Yeah, it's going to get paid, right?
Yeah.
So,
but you're spot on. That's another form of private credit, right? And again, what's getting labeled as private credit here is, and the poster child is this one company who you see her leaned headfirst into software companies, and this was also pre-AI, and that's some of what has driven the distress that they're experiencing. But you can see they spent a bunch of money buying platform, and ownership stakes in data centers. They've done a lot. So they were very highly concentrated in this one space. And the big piece on this is, unlike for real estate, like if you're lending to a software company, what's the collateral, right? It's really kind of the future cash flows.
Yeah, accounts receivable in the future.
Yeah, like that hopefully will continue to come in. Like it's kind of intangible. It might be the value of contracts, assuming that those contracts can be delivered on, or maybe the sort of a made up value for the IP. Like it's very squishy. These are not like, this is not real estate. You can't go out and like touch the thing that is like collateralizing this loan. And that's a huge part of this. And so one of the things that had driven me nuts for the last couple of years is every time I would see an article in any sort of mainstream financial media about private credit, it used that term and it almost exclusively meant lending to businesses and not real estate, right? And depending on the business, you got a construction company, or maybe they got a bunch of equipment that could be collateralized, right? So that's a little less risky. But like software businesses are like the riskiest thing that you can do, because if they default on the loan, there's nothing to recover. That's basically what happened here. And so we'll skip to the second one. This was the really scary headline from late.
Real quick, and I don't know if you're going to get to this at some point, but one of the things that these private credit funds don't have to do is they don't have to mark down their net asset values when some things kind of are going wonky.
Yes.
Right. So that can lead to this more drastic fall off.
Yeah, and I think it's either this one or the other article will kind of speak to that. But that's the markdown, even though it was private, because there's no collateral. So like, what are you valuing? You're valuing essentially a multiple of the future cash flows. And now if software in public markets is starting to come down, well, that implies that the value of private software companies are also coming down. And so now these loans are somewhat impaired and you're getting upside down in terms of a LTV type situation. But let me I have notes on this. So, I mean, the big, again, scary headline here, right? Private credit warning signs flash after Blue Owl unloads $1.4 billion in assets.
Not only that, but they found a chart that all points down.
Well, of course, yes, down and to the right?
Yeah.
And obviously showing, of course, Blue Owl being the worst of all these. This right here kind of speaks what has been frustrating to me. Wall Street's been eagerly selling private credit as a hot opportunity for individual investors. That sales pitch just got tougher.
Didn't we just do an episode on how they're going to try to start pushing private credit into 401ks?
Yes, and that ties into this as well, into what has led into some of specifically Blue Owl's distress. But again, I guess this kind of leads into it now. Blue Owl Capital, poster child for the industry, said it is liquidating $1.4 billion in assets to raise money to pay out individuals who bought into some of their funds in their heyday but now want to get out. And this last line here, the firm hoped the sale would shore up wobbling investor confidence. And that's really the big thing here, is you've got people that are seeing these headlines, and then it's a sort of a self-fulfilling prophecy where they're getting nervous, and so they want redemptions. And
what was the date on this article?
It was the 25th, I think.
Okay, so it's like the 19th. So this is even before their kind of big blow up, right?
This was the announcement that they were sort of fire selling this $1.4 billion of loans, which they sold. And I think, to give them credit, some folks have described this as fire selling. I think they sold them at like 99 cents on the dollar, right? So it's not like they were selling at 70 or 60 cents on the dollar. Like they basically got full value. But the fact is, you had this sort of crisis of confidence, and then investors wanted out. And partly because their funds were sold as being redeemable within 90 days from day one, investors bought. I think most investors that went into these, whether they knew it or not, thought that it was more liquid than it actually was, because they saw that 90-day liquidity right out the gate. And so I think there was some mismatch of expectations between investors about, again, what they were investing in and what this actually was and how illiquid these loans would be. That was really the big reason. They had this run on redemptions, right? And then they didn't have the cash to pay those redemptions for investors who wanted their money back. And so they have to find $1.4 billion worth of loans to sell off.
I think the fact that they were able to sell them for 99 cents on the dollar shows that it wasn't true distress. Because if they were sold at market, then someone else was willing to buy this asset. It really wasn't distressed.
Yep. Completely agree.
It was just a run on the banks with lack of liquidity.
Effectively, yep. But again, you've got, I think, a mismatch in probably expectations, right? They sold what was a long-term illiquid product to people who were kind of expecting to be able to trade in and out. And then now, again, you hear some of these headlines, people get concerned, then they hear about the thought of maybe redemptions are going to get cut off. Well, then that just further exacerbates the run. But yeah, that's a good point. Like, you have to question if someone else, now you could say, is this the greater fool theory? Maybe. But if someone else was willing to pay 99 cents on the dollar for these loans, were the loans themselves really that distressed? So how fair is it to say that private credit warning signs are flashing because this one fund had redemption issues? I don't know. That's again where I feel like there's more of a narrative that's trying to be pushed here because these numbers are flashy and whatever else than is actually there. There's a few takeaways from this article, and again, we will make sure all links to this are posted in the release notes. But Adam, you mentioned earlier 401ks, and they actually reference that here.
Yeah, I saw that a second ago when you were scrolling through it.
The industry taking steps to make private fund investments available through 401k savings plans, and I think that doesn't help this liquidity issue, right? Not to go off on that tangent, but then you have to wonder how liquid can these things be when the underlying investments are quite illiquid, right? Like, there's a reason it's called private credit for a reason. Like, it's non-bank, but then also the investment itself is intended to be private such that you don't have some of these problems. A lot of details here. I really don't think that this is as bad as people think. I think there were several things. I mean, some of the valuations of these companies went down on fears of AI disruption, and not necessarily because, again, the companies themselves were distressed. And I think that can partially explain why you had someone that was willing to pay 99 cents on the dollar for these loans. Again, this was the scariest sounding headline, and it just kind of made me mad because I'm like, if this is all you saw, if you were just scrolling through the Wall Street Journal one day and this is all you saw, private credit warning signs flash, it could turn you off the space. And then you hear us talking about how much we like real estate private credit, and you're like, well, wait a second, I thought that private credit space was like showing all these warning signs. It's just not the case. Okay, let me go on to the last one here. Of course, the Wall Street Journal is the best in the business at finding individual examples of something that they will then write about and make it seem like this is everyone's experience. So this article was from the 25th, so this was a slightly newer one. Blue Owl fallout sets off retail investor panic. Their advisors are urging calm. And I have to laugh here. They found Robert Hendricks, who is a investor in Ohio, and Adam and I are going to have to reach out to our friend Robbie Hendricks,
friend,
who is an investor in Ohio, and see if this is actually him. Basically, this sort of exemplifies what happens, right? It says here he immediately emailed his wealth advisor after seeing headlines on X saying Blue Owl was halting redemptions in one of its funds. And this is exactly how these things blow out of proportion. His advisor said he was invested in a different Blue Owl fund and that the fears around headlines were overblown, which I tend to agree with. But this is this exact logic. He says the last thing you want to hear as an investor is that the door is closing. And so it's a classic run on the bank.
It's funny to me. This could be it would be weird if it was. It'd be a different Robbie Hendricks, but it's funny to me because I don't feel like that's his mindset.
That's another reason why I'm pretty sure it's not. But Robbie, if you're listening, reach out and let us know if the Wall Street Journal managed to find you and got you leading an article here.
Or if maybe they just look up people in cities and quote them.
Entirely possible too. But there was another interesting quote. So here, the very end of the article, talking about, again, Robert Hendricks, he said, I tend to think where there's smoke, there's fire. And I think that's what concerns me the most about the presence of all of these headlines is that it just plants the seed of doubt. And now you've got someone, from our point of view, you have an investor who might have otherwise considered something, but because this appearance of smoke or the idea of smoke appearing somewhere is going to turn them off from a space that they shouldn't be avoiding, right? Because this entire space is now being painted with this very broad brush. And of course, not to make this a direct plug for our credit fund, but that's that's the big concern, right? Like our credit fund is completely different from this, and yet we still use the same label of private credit. And maybe the bigger takeaway on this is just if you're seeing these headlines and writing off an entire space of investing, that's probably bad, right? Like you should be doing a little bit more research to figure out what's actually being talked about here and figuring out the story.
Don't invest just off of headlines.
Exactly. Yeah. If we could, okay, that's the episode. All right. Thanks for listening, everybody. But no, that's like, you're spot on, right? Like saying private credit is like, honestly, like saying stocks, right? And like saying, well, you should avoid all stocks because of some reason. Maybe there's a good reason to do that. But the point is, calling something private credit tells you almost nothing about it. Like, yes, okay, so there's some sort of non-bank lending that's happening, and that's about all you know. And the details matter. Like if it's something that's highly collateralized, it sits in a good position, there's a lot of protections, that's a lot less risky than private credit that is lending to software businesses that have basically vapor for collateral. So I don't know. We could keep beating this drum, Adam. I don't know if there's any other things, takeaways or anything that you see or think about from this when this topic comes up.
What big events have happened in the last 2 weeks? There's this private credit meltdown. There's this war in Iran. And anything else big happened in the last 2 weeks?
I'm sure there was.
Claude is down.
Yeah.
Those things are happening, but you know what hasn't changed? The amount of rent that got collected on the 1st of March for across my portfolio.
Yep.
The amount of oil coming out of the ground, the price is getting sold for more right now, but our production didn't change by any of these world events.
Yep.
So I just think, having steady assets that you want to own for a long time, if there's major macroeconomic things that are happening, 08 style events, inflation like we had in the 80s.
70s.
It was the 80s when the rates were high.
18% mortgages.
Yeah. If we have those types of events, that can lead to downstream effects that are going to hurt tenant bases. It's going to hurt manufacturing. It's going to whatever those things may be. But I think a solid portfolio helps protect you against those.
Yeah. Totally agree. And, you mentioned the oil coming out of the ground hasn't changed, right? And rent was still due on March 1st and everybody had to pay. And they go back to, I don't know who I first heard say this, but talking about, you should really don't count your wealth in dollars, right? Count it in doors owned, barrels of oil owned, or, produced or whatever. Like that's the true wealth that's going to continue to persist regardless of some of these larger events. And then I think, specific to some of the concerns here with private credit, I guess there's a couple of things for an investor that's potentially looking at this. Obviously, anytime you're investing in something that is debt-based, the collateral matters. And I think that's what's getting sort of washed away here. And there's not much talk about it. But also liquidity structure. Blue Owl offered quarterly redemptions from day one, and they didn't have really any sort of meaningful lockup. And so I think that attracted a lot of investors who didn't really understand the illiquidity of the underlying assets and the fact that Blue Owl might not be able to meet those redemptions or might have to take drastic measures to do it. And I think that's sort of in contrast to our credit fund where we've got a 2-year lockup right up front. And we're very upfront about that. So our investors go in knowing that if they change their mind 6 months down the road, there's a lockup, right? Like there's no expectation of liquidity. And then again, for Blue Owl, it was concentration. Most of the headlines don't focus on the fact that their portfolio was like over half in software and tech services. And so, again, the things that just don't have a lot of tangible assets to function as collateral. If you're going to evaluate the space, I would say for private credit specifically, obviously do the research into anything. Don't just say, well, I saw something in the Wall Street Journal that said private credit's under stress, so I'm going to avoid all of that. The details matter. And then this is just the latest example, right, of a headline appearing in mainstream financial media that paints an entire sector as seeming bad. I remember this happening during COVID when a slightly different flavor, but there were headlines about, oh my gosh, apartment collections for, April 2020 were only like 89%. I'm like, well, the norm's like 91. So like, is it really that bad? So I have a healthy skepticism for all financial media, and I would encourage everyone to exercise that as well. I don't know, Adam, any other closing thoughts?
It might be completely ridiculous or off topic, but I think that we live in a world right now where just the war in Iran and things of those nature, a lot of people are like, oh my God, how did this happen? And I've just seen so many videos recently. Like, if you just listen to Trump for the last literal 50 years about what his thoughts were on Iran, it was that we should bomb the shit out of him. I mean, this is not a surprise. So the world that's going on right now, if you're trying to get around these big macroeconomic items, and a lot of them are based around U.S. political structure, maybe just listen to what the freaking president says, because he seems to do what he's going to say he's going to do.
Yeah.
Like it or not, he's not beating around the bush.
Yeah, not to go down that one, but I've had that conversation with several people in the past, even during Trump's first term. It's like, why are you, like, he's fairly simple, right? Like he kind of does what he says he's going to do. Like there's not a lot of like deep political games here. Yeah. So, and we sort of, a good example of that was bringing back bonus depreciation, right? Like that was a big thing in the campaign. And sure enough, like 2 weeks or something into his presidency last year, he signed an executive order to do that. So, there were a lot of people that were sort of positioning portfolios around that. And yeah, I guess to tie back to the initial conversation about if there was a section of macro that you should focus on, it's probably that level. And again, not trying to plan out what happens when there's massive hyperinflation because this event happens, which triggers this event, which triggers this event. And that's getting a little too far removed. And I would be remiss if I close out an episode talking about private credit. We have a private credit fund. It
invests purely in Blue Owl.
Yeah, it's a feeder fund for Blue Owl. No, we are real estate, private credit, backed by great properties, strong operators, cash flow, 6% pref, and 80-20 split, right? I think
it's an 80-20 split. One thing I want to touch on there, though, is that, we do have an asset in the fund that's distressed.
Yeah.
And it's been managed, right? We wrote down the value of it. Operators come in and cleaned, a new operator has come in to manage the rehabs. It's not completely distressed, but their rehabs were over budget and their occupancy went out of compliance.
Yep.
So there are tools to go in there and clean that up, not just, oh God, the software company's not worth what we thought it was.
Yeah. Yeah, for sure. But if that's something, we make monthly distributions there. There's also a reinvestment option. We've got a lot of investors that have taken that aren't taking their cash distributions. They're just choosing to let it roll and let it compound. And you start doing that over long enough time. We've got some investors that it's fun to watch their account balance continue to grow month after month. So
you get to a point in life when you have enough wealth and you can just keep letting it compound. We have someone who's approaching 3-digit ages, an age that has 3 digits in it. And she chose to compound. Yes.
So
for later.
Anyway, open for investment. This is 506C, so accredited investors only, but we would absolutely, if adding some cash flow to your portfolio and getting exposure to some much more collateralized and secure private credit than what you're seeing in the headlines, this is a great way to get exposure to that. With that, we'll get out of here. Again, Adam, I'll ask you for any final parting thoughts.
Yes,
excellent.
sir.
I always like it when you don't have anything to say. Just kidding. Everyone, we appreciate you listening. If you've enjoyed this, as always, go give us a, whatever it is, like on YouTube, subscribe to the channel, give us a 5-star rating on Apple Podcast and whatever it is you do on Spotify. I have no idea. But do all that. Let the computers know you're enjoying this, and we'll get the message out to more people. But again, we appreciate you listening. We'll catch you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.